This is Your Money, Your Wealth.
Hey, welcome to another episode of Your Money, Your Wealth. Joe Anderson here, certified financial planner alongside the big man, Big Al Clopine, sitting right over there. Got a great show lined up. Here's the deal. I'm a little frustrated today. What is the biggest obstacle you think that is in front of you to have a successful retirement? Okay, we've had some volatile markets over the last, let's say 3 or 4 weeks. And most people will say the stock market, but it's not. It's you. It's your behavior to the stock market is the biggest thing that's stopping you to accomplish your financial goals. October 15th, the news just came out. $5.8 billion flew out of mutual funds, stock mutual funds. So when the market drops 1,000 points, what are you doing? You're getting out of the market. That's the last thing that you want to do. Two of the biggest reasons why you're not successful financially is that you're not prepared when markets go down. And secondly, you do not have a tax plan. In Al and I's opinion, taxes will take way more from you than the stock market ever will, but you don't necessarily have a plan for taxes, and you don't have a plan for your stocks or your portfolio. That's what's on my mind today. So a couple of things I want to get into. I want to bring Bing Crosby, now Big Al, into the mix. And I want to dive in and talk a little bit more about taxes on the retirement distributions and some of the behavior. If you have a plan in place, control the things that you can control. You can control your risk in your portfolio. You can control the fees and the costs and the commissions of what you're paying your broker or your brokerage house. And then finally, you can control the taxes if you have appropriate plan. So let's bring Big Al in. My man, a lot of things out there, a lot of scary stuff. The markets go down, the markets go up. Warren Buffett's losing billions of dollars and then he's gaining it back. People are freaking out. What do people do?
Well, it's a good question, Joe. And really, we can't necessarily control the market, but we can control our reactions to the market and we can control our taxes to some extent. And a lot of understanding and controlling taxes is simply understanding what taxes are. So we could spend show after show after show, but today we're going to focus on your retirement accounts and understanding what's possible with your retirement accounts. Like, first of all, when can you take those dollars out? When are they available? There's certain ages depending upon which type of accounts. And then the second thing is how are they taxed? And a lot of you may be surprised how they are taxed. They're actually taxed at ordinary income rates, the highest of tax rates when you pull those dollars out of most retirement accounts. And then if you do it wrong, if you make mistakes, there are numerous penalties, starting at 6% on some penalties, all the way up to 50%, 50% on certain types of penalties. So you don't want to make those mistakes. And then we're going to bring this all together throughout the show with various strategies that you need to understand. Because here's the thing, if you understand what the rules are with your retirement accounts, you can save tens of thousands of dollars through retirement, in some cases hundreds of thousands of dollars in retirement. And then it's like, so if I can save this tax money, I can either have a more robust retirement or maybe I don't have to take as much risk in my portfolio, so when it is volatile, then I don't see my portfolio swing nearly as much. And Joe, I think it's really all about education, figuring out what you can control, and then coming up with a plan to take care of that.
Well, if you think about it, let's look at retirement plans in general. When they first came out, it was under ERISA in 1974. In 1974, so like the defined contribution plan, so your 401k, your 403b, that you're placing money now into the retirement plan and letting it grow tax deferred. You got a tax deduction putting the money in, but back in 1974, the top marginal rate was 70%, 70. And then if you take a look at the history over the last, 40 years, the financial services industry has told you to do this. Save as much as you possibly can pre-tax inside these 401k plans, let it grow 100% tax deferred, and then when you're in retirement, you can pull the money out, and guess what? You'll be in a lower tax bracket. Well, that's true for many of you that haven't saved. But for those of you that watch this program, that listen to our radio show, that are our clients that come in, you have done a really good job of savings, but unfortunately now, tax rates started here and they're going down. The stock market is all over the board. So people have lost money in stocks in our opinion, you're going to lose even more to taxes because of how the taxation system works today. It's not a one-dimensional tax system, Al. There's so many different rules and laws that have just come into effect just in the last year, and we'll see more and more of that coming up in the next years, in the next few years to come.
Yeah, no question. So let's get into this. Let's talk about what some of the rules are with regards to your retirement accounts. So when you've got a, the question is, when can you withdraw money? And the answer is, when you have an IRA, it's 59 and a half years of age. When you have a 401k and you're separated from service, either you quit your job or you retired, it's actually 55 years of age.
Yeah, this is a big deal here, because if I want to retire early, right, you want to keep the money in the 401k plan, because at 55 there is no 10% penalty. If I move it over to an IRA and I take the money out prior to 59 and a half, then you're assessed a 10% penalty. Any dollar that's in an individual retirement account, you have until age 59 and a half, or you have to wait until 59 and a half to avoid that 10% penalty, unless you do a 72T tax election, we'll get into later.
We'll get into that momentarily. But the next thing is, so we can take money out at 55 and at 59 and a half for IRAs, 401ks, but when must we take money out of our retirement accounts? And the answer is, with an IRA at 70 and a half years of age, we have to start taking money out. That's called a required minimum distribution. And with a 401k, it's also 70 and a half years, with one exception. It can be longer if you're still working and still active in that 401k. So if you're 72 years old and you're still in a 401k and you're still employed, then you don't have to take that required distribution until the year after you retire.
And then, so that's another reason why you want to keep it in the plan, because if I'm still working and I'm in my 70s and 80s, hopefully you're still not working in your 80s or 90s, but if you are, you do not have to take that required distribution until April 1st, the year after you retire. So remember that. If I'm still working, I'm still an active participant in my retirement account, you do not have to take that mandatory distribution. Now, mandatory distributions, the law came out and says, you know what the heck is an RMD anyway? When you're 70 and a half, you are mandated by law to take income, if you want it or not. So at 70 and a half, it's a certain percentage, and as you age, they want more and more and more of that money to come out of that retirement account. So if you think about it, when you started saving money into these retirement accounts, you got a small tax deduction, and then it grew tax deferred for you. Then you turned 70 and a half, you got this big pot of money here that you don't necessarily need because you have Social Security, pensions, real estate income, and the like, or whatever. You are mandated by law to pull that money out. And why? Because they want their tax money. If you do not have a strategy in place to reduce the tax burden long term, I'm telling you, the IRS will take way more than they should.
Yeah, Joe, let's get into how you actually are taxed. And some people are surprised when we talk about this. So really, if you look at the way 401ks are taxed, IRAs are accounts, there's pre-tax dollars. In some cases, there's post-tax dollars. Pre-tax dollar means when you put money into an IRA or 401k, you got a tax deduction. So when you pull the money out, since you never paid tax on it, you have to pay ordinary income tax rates, which, by the way, are the same rates that you've always paid for your salary, interest income, rental income, and so forth. It's the highest of rates. Now, in some cases, you put money into these plans without a tax deduction, and in that case, then you don't have to pay taxes on that part. But let's go over a little example so that you kind of get a sense of this, and that is, if you have a $50,000 distribution in retirement, and let's say you're in a 25% tax bracket between federal and state. So what's that mean? That means your tax is $12,500. You don't get the $50,000, you only get $37,500. And a lot of people don't realize this. The money that's in your IRA and 401ks is not all yours. You got to pay taxes on that, and you get a net amount, just like a salary.
Right. If you want 50 grand, you got to pull out 6250 or even more, because the more money that you pull out, of course, the more of that is going to be taxed as ordinary income, and then more and more money goes to the IRS. Don't let that happen to you. Get a strategy in place. What we're going to give away today is a free retirement assessment. Let's take a look at what you're trying to accomplish and figure out ways to mitigate the taxes long term. I'm telling you, if you do this right, you will save tens, if not hundreds of thousands of dollars. You can only control the things that you can control, and taxes is one of them. Call the number right now, 888-994-6257. It's at the bottom of your screen. Call that number right now. Get into our office. It's absolutely free. There's no obligation. Call the number, get in, get straight on your finances, because there's a lot of things that you want to make sure that you do before the end of the year. We're going to take a break. We'll be back in just a second. Show's called Your Money and It's Your Wealth.
So the question this week is, I have a retirement plan at work, so where should I be saving my money? Well, what you want to find out is whether or not there is a Roth component inside your 401k plan at work. So since 2006, Congress has enacted where you can now have plan sponsors authorize Roth 401k contributions into the existing retirement plan. So you want to look to see if your plan has the Roth 401k availability. Plan sponsors, over 60% of them have adopted the Roth 401k. It's a great place to start saving on an after-tax basis, and it still has the same contribution limits as the traditional 401k. So you want to look to your tax bracket to see if it makes sense to be going into the traditional 401k, or if it would make more sense if you're in the lower brackets to be contributing into the Roth 401k. Now be aware that once you make a contribution into the Roth component, you would not be able to transfer the funds back into the pre-tax side of the traditional 401k. But once your money is in the Roth 401k, it's now growing tax-free for the rest of your life.